Welcome to the Deep Dive. We're the place where we, cut through the noise and get straight to the insights that matter most to you. Today, we're embarking on a really fascinating deep dive. We're looking at a comprehensive new report from Morgan Stanley, and it puts the spotlight on a huge player in the global market, Reliance Industries. Our mission today really is to unpack this core question the report raises. How exactly is Reliance planning to create its next U.S. $50 billion in value? I mean, that's a staggering claim, right? And what makes it really compelling is that the report points to some maybe surprising areas for growth, unexpected ones.
Exactly. Yeah, this deep dive, we're going to pull back the curtain a bit on how Reliance is looking to fundamentally, reinvent itself. There's a profound emphasis on two interconnected themes that, might not immediately leap to mind for a company known mainly for energy and retail. We're talking new energy and AI infrastructure. We'll be digging into the specific pathways they're mapping out for this growth and Morgan Stanley's pretty bold predictions.
Okay, let's unpack this then. This idea of reinvention is the key, aiming for that huge UF $50 billion bump in market cap. And here's where, like you said, it gets really interesting. Banking on new energy and AI infrastructure, it feels different. How do these two, seemingly separate areas actually fuel such massive value? What's the connection Morgan Stanley sees?
Well, the core idea is genuinely innovative. Morgan Stanley estimates there's potential for up to US $60 billion in value creation just from Reliance's new energy vertical alone. But crucially, this isn't just about producing green energy like solar panels on a roof. It's about strategically using those electrons. They want to power their own critical operations, think chemicals production, data centers, even their existing refineries. It's a comprehensive, very integrated strategy.
Right, integrated. And the AI connection you mentioned is particularly eye-opening. The report calls general AI the next frontier for Reliance. How are they actually integrating something like that into their energy operations? What does it look like practically?
That's the really clever part. Reliance is actively retooling its massive Jamnagar energy complex, this huge facility, traditionally for oil and gas.
Yeah.
They're now setting it up specifically to monetize its energy production for generative AI. That's a massive global need right now, reliable power for AI. They've announced some pretty ambitious plans, powering 1 gigawatt of data center capacity, and they'll be using NVIDIA's latest Blackwell chips.
Wow, 1 gigawatt. Just to give us a sense of scale, what does that actually mean in terms of hardware?
It's almost hard to grasp. A 1GW data center like that would need roughly 678,000 of those B100 chips. Even for just their own internal use, maybe around 200 megawatts, they'd still need something like 135,000 of these cutting-edge chips. It's enormous demand.
Okay, so connecting these dots. Green energy they produce themselves, powering huge AI data centers stuffed with the latest chips. What does this mean for the bigger picture? This isn't just about Reliance changing its business model, is it? It feels wider.
Exactly. If we zoom out, it strongly suggests India could become a really significant alternative data center hub globally. And Reliance would be providing a critical piece of that puzzle, potentially green-powered infrastructure at scale. The company is actively talking about a large-scale internal adoption of AI, embedding it across all group processes, optimizing everything. So it really raises a fascinating question for all of us, doesn't it? How many other large industrial players out there might follow this kind of integrated energy AI model? What does that possibility spark for you?
That vision of India as a major data center hub, powered by Reliance, is definitely forward-looking. Very ambitious. But let's bring it back to the present for a moment. Investors always want to know about the near term. The report gives us a preview of their upcoming June 2025 quarter earnings. That's the first quarter of their 2026 fiscal year, or 1QF26. What should we be looking for there? And how might these numbers actually impact investor confidence in this whole reinvention plan?
Right. So the expectation is for a relatively flat quarter-on-quarter performance. But don't let that fool you. This is actually projected to raise investor confidence. Why? Because it shows stability and predictability in earnings delivery. Key segments like refining, chemicals, and retail are expected to meet expectations. Overall, Morgan Stanley anticipates consolidated EBITDA, that's core profit, rise by about 16% year over year. And consolidated earnings, up by a pretty impressive 27% year over year. So strong annual growth, even if flat sequentially.
Okay, let's break down those key segments a bit. What's the outlook for their traditional powerhouse, the oil to chemicals or O2C business?
Yeah, OTC is projected to see a solid 19.6% year-over-year jump in EBITDA. What's driving that? Strong global fuel margins, mainly, even with some refinery maintenance factored in. Plus, the report highlights rising crude discounts from the Middle East, cheaper inputs for them, and an expected lift in chemical margins as global costs rise. And looking a bit longer term, their PET and PVC plastic capacities are set to ramp up by 2028. That could add another 5% to O2C EBITDA, so still a core growth driver.
Got it. And what about their huge retail arm? Reliance Retail has been expanding like crazy. What's the story there? Any bumps in the road?
Retail is expected to show about 17% year-over-year revenue growth. Pretty healthy. Key catalysts are traction in their new fashion brands, their own in-house consumer brands gaining ground, and of course, quick commerce. But interestingly, while they're growing overall, the report does note that GeoMart Act's incremental downloads seem to be lagging behind competitors like Blinkit and Big Basket. So that suggests, the competition in that digital grocery and quick commerce space is still really intense. They haven't won that battle yet.
Okay, and finally, telecom, Geo. It's fundamentally changed the Indian market. What's the outlook for that giant?
Telecom, mainly Geo, should see around 6.5 million net subscriber additions quarter on quarter, still adding users at a good clip, and they expect a slight increase in ARPU average revenue per user, getting a tiny bit more from each customer. But there's also the impact of 5G monetization to consider. As they build out 5G, it leads to higher depreciation and interest costs. So while 5G is a growth driver, those costs might offset some gains elsewhere when you look at sequential earnings. It's a big investment phase.
Right, that makes sense. So beyond these immediate earnings, the report really digs into the long game, doesn't it? It outlines multiple triggers for more earnings confidence over the next couple of fiscal years, F26 and F27. What are the really big, bold moves they're making for the long haul, especially in that new energy space you talked about?
Oh, absolutely. For new energy, the ambition is, frankly, monumental. They've started with a 1 gigawatt line for renewables, but the plan to be fully integrated with a staggering 10 gigawatts capacity by the end of 2026, that's just a couple of years away. This includes a major expansion of lithium ion phosphate battery capacity and, importantly, green hydrogen production. And crucially, they're focusing hard on cost reduction. They're building this scale on 2,000 acres near Kandla in Western India, using NEL's alkaline electrolyzers. The scale, the technology choice, the location near a port for logistics, it all signals a really serious commitment to becoming a leader, and a low-cost leader, in future energy.
10 gigawatts by 2026 is incredibly fast. So with all that massive investment going into new energy, how do their existing giants like O2C and retail fit into this long-term picture? Are they just funding the new stuff or still growing strongly themselves?
No, they're definitely still expected to be strong growth engines in their own right. The O2C vertical, for instance, is projected for a 13% earnings Haji compound annual growth rate over F25 to F28. That's solid, steady growth. That'll be supported by things like the refining upcycle, more domestic fuel sales, and those cheaper crude discounts we mentioned. And Reliance Retail, as we discussed, projected for 17% top-line growth in F26, driven by new brands and quick commerce. So these established businesses provide crucial stability and cash flow while the new energy arm scales up. They're not being left behind.
Okay, so bringing it all together, this ambitious strategy across new energy, AI, telecom, retail, O2C. What does Morgan Stanley conclude this all means for the company's valuation? How do they actually put a number on it?
Well, they maintain an overweight rating on Reliance. Basically, they expect the stock to do better than the market average. Their price target is Rs 1,617 per share, and they're forecasting a 14% earnings CGR over the next few years, F25 to F28. How they get there is using a sum of the parts methodology, or SOTP. It's pretty standard for conglomerates like Reliance. They value each distinct business segment, retail, telecom, O2C, new energy separately, using different multiples based on growth prospects, risk, etc. And then they all sum up those parts. For instance, they value the new energy investments, even at this early stage, at about US $17 billion enterprise value. They use a price-to-book multiple of 3x for that, reflecting the high growth potential as the segment ramps up.
The SOTP approach.
Yeah.
And they also map out bull and bear cases, right? Best and worst case scenarios. What could really push the valuation up or down?
Absolutely. That's always insightful. Their bull case, which values the company much higher at Rs 2034, imagines things going really well. Scenarios like even stronger O2C margins than expected, e-commerce really taking off even faster across India, and very successful monetization of their digital ventures. On the flip side, the bear case, down at Rs 12,210, considers the risks. Things like lower refining and chemical margins sticking around, more intense competition in telecom without getting those ARPU hikes they need, or maybe higher than expected cash burn in retail and new energy as they invest heavily. It really brings up that crucial question for you, the listener. How much of this ambitious future, this reinvention, is already baked into the current market price? And what would trigger a major re-rating, up or down?
Yeah, that's the key question. The report also flags some interesting risk and reward themes,
Hmm.
calling Reliance positive for disruption, pricing power, and renewable energy. What do those themes really tell us about the core investment drivers, and what are the most critical factors that could, make or break this whole strategy?
Well, the core investment drivers are pretty clear. Can they allocate capital effectively? Can they execute on these massive projects? Can they continue to manage their debt? Plus, obviously, the impact of their new energy offerings taking hold and the chemical cycle improving. On the upside, the rewards could come from global refining and chemical markets getting even tighter, maybe gaining more market share in telecom if competition eases, and landing some really strong new energy partnerships. Those are the potential tailwinds.
But no investment is risk-free, especially at this scale. What are the specific pitfalls the report warns about? What could go wrong?
Yeah, they highlight a few key risks. One is a potential ban on single-use plastics. That could definitely hurt margins in their chemicals business in the medium term. Another big one is delays. Delays in actually monetizing their energy and telecom assets, getting revenue from those investments, and of course, given the sheer scale of the new energy plans, any execution hiccups, problems building things out, technology not working as expected, those are significant concerns too. It's just a reminder, isn't it? Even the most brilliant strategy depends entirely on effective implementation on the ground.
Absolutely. This deep dive really paints a picture, doesn't it? A company the size of Reliance, thinking about such a massive transformation, moving so deliberately beyond its traditional strengths into these cutting-edge frontiers, AI-powered data centers, huge green energy production. It's a blueprint for reinvention on a truly grand scale.
It really highlights that complex interplay, between technology, energy, consumer markets, all shaping the future of global business. The scale of their vision is just immense. From powering AI with their own green energy to potentially reshaping India's entire digital infrastructure, it gives you a compelling glimpse of what might be possible.
So as you, our listener, reflect on all this, maybe consider this question. In our world, that's changing so fast.
Yeah.
How might other established industries, maybe even ones you work in or follow closely, leverage their own existing assets, their infrastructure, their know-how, to pivot into completely new, high-growth areas, just like Reliance is trying to do with energy and AI? What hidden potential might be unlocked by repurposing what's already there? We really hope this deep dive has given you a shortcut to being well-informed, maybe sparked a few aha moments about where business is heading. Until next time, keep digging for those insights.